again, Buffett and Munger say in the near term, markets are voting machines. In other words, they measure perception. In the long term, markets are weighing machines. They pay attention to what companies are worth. So in the very near term, the narrative and emotion is what drives markets. If somebody is a psychologist, perhaps they can trade emotion. I'm not. I'm a banker. I trade value. In specific answer to your question, resource stocks are stocks. And to the extent that the stock market sells off in the near term, the resource stocks will sell off too. I remember the crash in 1987. Ironically, I got married 2 days before it, so I remember it fairly well. Gold and gold stocks held up for precisely 1 day. In circumstances where liquidity goes away, where there's broad spread panic in the market, the first thing to remember is that the sell decisions aren't made by rational investors. They're made by speculators who are scared to death. And more particularly, they're made by margin clerks. And the margin clerk sells what has a bid. It's irrelevant to that person what the ultimate performance of the security will be. So it's important to note that in the near term, in a liquidity crisis, in a confidence crisis, everything falls like a boulder off a bridge. That which has real value recovers and can recover very, very, very quickly. But again, if you yourself as an investor or speculator don't have an opinion as to value, but merely have information with regards to price, you will likely get shaken out in a decline in confidence because you won't have any confidence in the stock. You'll only have confidence in the market, which will have been shattered in the circumstance that you see. I remember certainly in the 1987 decline, watching the shares as example of Kinder Morgan, the large and very stable pipeline operator, decline to the point where Kinder Morgan had a 15% sustainable dividend yield. The pipelines are very easy to figure out. You put goop in one side of the pipeline, you pipe it, you take goop out of the other side of the pipeline. It's a very long-term, very stable business, a business where competition, if it develops, takes 10 or 15 years to develop. So these were extraordinarily stable cash flows. And yet, because people were afraid of the market, they took the dividend yield for Kinder Morgan from 6 to 15. People who had a sense of why they owned Kinder Morgan, people for whom a 15% stabilized yield, particularly tax advantage from depreciation, was worthwhile. Those people had the courage to wander in and buy Kinder Morgan. And by the way, not all of them got in at the bottom. Not all of them got a 15% yield. Some of them only got a 12% yield. The point is that if you take advantage of the distress of others, you don't need to buy at the absolute bottom. If you do buy at the absolute bottom, it was complete fluke, completely random. But if you view stocks that are bought during panic from a valuation perspective, and you view them in the 2 to 5 year time frame.
We have a pair of questions here that pit sort of the phenomenon that we're seeing both in our financial world, having to do with inflation, monetary world, as well as our economic world about the potential for recession and depression against what we can expect to happen to companies. So first, let's take the monetary one. Murray Platt says, how do rising input costs affect mining stocks, say like First Majestic? And that's just an example. Any miner is dealing with increased costs of energy, of labor, of parts, of repairs, of all kinds of things right now. And how do you see input costs and inflation affecting mining stocks?
Inflation in terms of inputs is going to be important. More importantly, is going to be capital cost inflation, which is to say the cost of developing new mines, both from the point of view that capital costs are increasing, which is to say interest costs are increasing, while social costs, which is to say taxes, permits, and fees are increasing. The lead times necessary to put something into production are increasing. And then the prices of skilled labor, machinery, steel, cement, all of those things are increasing. To the extent that companies control existing producing assets that are long-lived assets, and can enjoy cash flow off those assets for 15 years, 20 years, 30 years, those companies have a real durable competitive advantage over companies that will have to develop properties with uncertainty as to the interest rate that they'll pay, the price that they'll have to pay for steel, whether or not they'll have access to skilled labor. So inflation favors incumbents. And it's important to know in natural resources that the incumbents during periods of rapidly increasing input costs will do better than new entrants to the market.
All right. But let's zoom in a little bit farther. So they'll do better. Do you see that as an existential threat to mining companies in that they're facing increasing input costs and they're still in an environment of let's just say that the output, the sales prices of metals right now are not keeping tabs with nominal price increase on anything else currently?
No, I don't. I see natural resource-based businesses as being businesses that are essential businesses. What you see is that high prices are the ultimate cure for high prices and low prices are the ultimate cure for low prices. What you will see is after a period of time, and time is always the critical component in making these discussions, if an industry is in liquidation, which is to say if the selling price of the product is lower than the cost of producing it over time, the inevitable outcome is that the price goes up or else the commodity becomes unavailable. One of the reasons, Dunnigan, why I've been so insistent on your show in the last 3 years that the uranium price has to rise was because uranium was priced well below the cost of production, which is to say the industry was in liquidation. The only outcome from that is two. Either the lights can go out or the price can go up. Now, the element is time. People need to be prepared to buy industries in liquidation and understand that it might be 2 years or 3 years before the circumstance rights itself. As you yourself, with regards to the lessons with regards to your kids, said, certainty comes at a cost. And so the question involves more investor perception and behavior than markets. An example would be around copper. There are plenty of incumbents that could make a lot of money at $2 copper. And so at $4 copper, there's an awful lot of room. Yes, they will face pressures from higher fuel costs, higher rents, higher social rents, which is to say higher taxes, all that type of thing. But the truth is that the industry is living on production from copper for the most point in time from giant copper mines that are in effect my age, long past their prime. And you have a circumstance where the longer the industry goes without making new investments, the more certain that you are that the copper price goes up. The difficulty comes to the fact that most investors talk a good story, which is to say they think of themselves as being 5-year investors, 6-year investors, 7-year investors, investors through thick and thin. When in truth, most of them are sort of will-o'-the-wisp, nervous speculators. Most investors seem to prefer to buy something after they have the psychological validation of seeing the price rise.